Welcome back to another Talk Tickers Deep Dive, everyone. We are so glad you're joining us today.
Yeah, thanks for tuning in. We've got a really fascinating breakdown for you today.
We absolutely do. Our mission today is to dig into the Diamondback Energy Q2 2026 earnings call. And we're going to cut right through all the Wall Street jargon to give you the actual data, the real story.
Right, and give you the actionable bottom line on what this means for your portfolio.
Exactly. And Diamondback, which trades under the ticker symbol FANE, by the way, this quarter, it's not just your traditional oil and gas story.
No.
It's this wild intersection of insane drilling efficiency, massive debt reduction, and surprisingly a huge leap into the AI data center space.
Yeah, the data center stuff is wild. But to ground this for you, our main focus today is really going to reveal how Diamondback is maximizing what we call its option value, especially in such a highly volatile market.
Right. They are putting on an absolute masterclass in capital discipline right now. So let's just jump straight into the headline numbers.
Let's do it.
So on the call, management was intensely focused on operational cash flow. And the standout figure, honestly, is the massive debt reduction.
Oh, yeah. It was huge.
They paid down $1.6 billion in net debt in just one quarter.
Which is just a staggering amount of capital to move off the balance sheet in a 90-day window, especially for an independent producer.
Yeah, exactly.
Yeah.
But translating that to value, why should an investor care about that specific number?
Well, what's fascinating here is the mechanics of how that creates value. In corporate finance, you have your enterprise value, right? Which is basically the market value of your equity plus your outstanding debt.
Right.
So when a company uses $1.6 billion of free cash flow to just extinguish debt, that value doesn't evaporate.
It has to go somewhere.
Exactly. It literally transfers directly from the debt side of the ledger right over to the equity side.
Which thickens the actual equity stake of the shareholders.
Yep. And management even quantified this for us on the call. They noted that $1.6 billion debt reduction translates to a direct transfer of $5.60 per share.
Wow. Just directly to the equity holders.
Right into their pockets, basically, in terms of intrinsic value.
That's incredible. And to generate the cash for that, they had to deliver on production, which they did. Production was up roughly 4% from the start of the year.
Yeah, and in the Permian Basin, moving the needle 4% organically is a massive logistical feat.
For sure. And they mentioned they saw some positive price signals back in March, right?
Yeah, they did. They saw the pricing environment improving, and they had the operational agility to just lean right into it.
But the thing that really caught my eye was the margins. Specifically their lease operating expenses, or LOE.
Oh, man. The LOE numbers were exceptional.
They drove it below $6 a barrel, which, considering all the inflation we've seen in steel and labor and power, getting below $6 is a major win.
It's a massive margin protector. LOE covers all the daily costs to keep a well producing. Surface maintenance, water disposal, field labor.
Right, the recurring stuff.
Exactly. And a big driver of keeping that so low was integrating their recent Endeavor acquisition.
Okay, let's unpack this a bit, because how exactly are they increasing production, dealing with inflation, and still driving costs below $6?
Well, they use this phrase on the call. They call it stacked innovation.
Stacked innovation. I like that.
Right. It's basically the idea that in a mature basin like the Permian, you're not going to find one magic technology that doubles production overnight.
Right. There's no silver bullet anymore.
Exactly. It's all about compounding marginal gains.
It kind of reminds me of an F1 pit crew.
Oh, that's a perfect analogy.
Right. They didn't invent a magical wrench to go from a 10-second pit stop to a 2-second pit stop. They just shaved off milliseconds on the jack, milliseconds on the tires.
Yes, precisely. And Diamondback is doing that with resource extraction. The CEO gave this crazy stat. They went from drilling a standard horizontal well in 30 days down to just 5 days.
Wait, really? From 30 days to 5 days?
Yeah, 5 days from spud to rig release.
That is just, that's a structural transformation right there. Time is literally money when you're renting a rig.
Exactly. You're shaving 25 days of day rates off the capital required. But doing that requires pushing the absolute limits of the physics involved.
So what are the specific technical drivers making that 5-day turnaround possible?
Well, the chief engineer got into the weeds on this. First, they are using larger diameter tubulars, the steel casing in the wellbore.
Right, to reduce the friction pressure.
Exactly. Larger pipe means less friction, which allows for a much more aggressive early flow back after they frack the well.
So the well reaches peak production way faster.
Yep, accelerates the payback period. But it's not just the drilling, it's the completions too. They are heavily utilizing all-electric frac fleets, the E-fleets.
Oh, right, because normally those run on diesel. Right?
Yeah, massive diesel pumps, which exposes them to crazy diesel fuel inflation. But the E-fleets run on natural gas turbines.
And they use their own field gas for that, right?
Exactly, a totally closed-loop system. They bypass the diesel supply chain entirely.
That cuts out so many logistical headaches. No fuel trucks, less emissions.
And it led to this astonishing metric they reported. They achieved continuous pumping that averaged over 21 hours a day on the surface.
21 hours a day. For the whole quarter.
Yep.
That means they had less than 3 hours a day for maintenance, moving equipment, all of it. That is a razor-thin margin for error.
It proves their supply chain is just dialed in perfectly.
Speaking of dialed in, there was also this massive natural gas surprise. Natural gas production drastically outperformed.
Yeah, which is usually a problem in the Permian because it's associated gas, right? It's a byproduct of the oil.
And there's never enough pipeline capacity to take it away, which is why the Waha hub price crashed into negative territory in Q2.
Right, literally paying people to take the gas.
Yeah.
But Diamondback didn't just take that hit. They got really aggressive with their local marketing.
And they mentioned using these split connects, I think.
Yeah, split connects. Basically, instead of hooking a well pad to just one processing plant, they spend the capital up front to connect to multiple competing systems.
Oh, that makes sense.
Yeah.
So if one pipeline backs up, they just route the gas to the other one.
Exactly. It reduces flaring, keeps the oil flowing, and allows them to arbitrage the prices.
And honestly, it paid off because Waha hub gas prices finally turned positive for the entire month of July.
Yeah, that new pipeline capacity definitely helped bail out the basin a bit late in the quarter.
All right, so that's the current snapshot. But here's where it gets really interesting. Let's pivot to management's guidance for 2027 and beyond.
Yeah, the future blueprint is where you see their macroeconomic bets.
So what exactly did they say about the macro environment?
Well, their core bet is that global oil inventories are actively draining right now.
Really? Despite all the geopolitical noise?
Yeah. The CEO basically said, look past the daily trading sentiment. The physical reality is that sovereign buffers are depleted, commercial inventories are tightening, and they will need to be refilled.
So because of that structural deficit, they aren't just holding production flat like a lot of their peers, right?
Correct. They are guiding toward low single-digit organic growth.
Wow. Okay. Going on the offense.
Yeah. They plan to spend a little over $1 billion per quarter in 2027, running a consistent 5 frac crews.
Wait, we have to talk about the craziest part of this guidance. The data center mega theme.
Oh, the Bryant Ranch project. This is a game changer.
So Diamondback has this 30,000 acre asset, and they are pitching a bridge-to-grid solution for AI data centers.
Yep.
But I have to push back here. If I'm a retail investor, I bought an oil and gas company. I didn't buy a tech power provider or a real estate developer. Isn't this just a massive distraction, like mission creep?
It's a totally fair question. And management hit that exact criticism head on. If we connect this to the bigger picture, they are strictly staying in their lane.
Okay, how so?
The CEO was emphatic. They are not building the data centers. They are not buying servers.
Right.
They are simply acting as a resource landlord, monetizing their surface land, their water rights, and their natural gas.
I see. So it's basically a behind-the-meter setup.
Exactly. The data center is built right next to the gas production. The gas goes straight into on-site generators to power the servers.
So they completely bypass the traditional congested electrical grid.
Which is the biggest bottleneck for AI right now. Tech companies can't afford to wait 5 years for a grid connection.
So Diamondback is aiming for first gas to this project by the back half of 2027.
Yep, and then ultimately seeking a grid connection via ERCO by 2028.
To actually sell power back to the Texas grid, that is incredibly smart. It takes that stranded Permian gas and turns it into a high-margin annuity.
Exactly. It's a brilliant monetization of an idle asset.
Okay, so beyond the data centers, they also highlighted 2 other massive growth levers. Let's talk about the Barnett Shale development.
Yeah, the Barnett is fascinating. It's a deeper, denser rock beneath their Permian acreage. Historically, it was just too expensive to drill.
But stacked innovation strikes again.
You got it. Through all those drilling efficiencies we talked about, they are driving drilling costs in the Barnett down to around $400 per foot.
Wait, 400 a foot? I thought that used to be like 1,000 a foot.
It was.
So that's a 60% cost reduction.
Right.
That suddenly makes millions of barrels of previously stranded oil economically viable.
Exactly. It organically expands their inventory without having to go out and buy another company.
And part of that is this crazy U-turn well geometry they mentioned, right?
Yeah, drilling 5,000 feet, physically turning the bit 180 degrees underground and drilling back the other way.
That just blows my mind. The engineering required for that is insane.
It really is. But there's a second massive catalyst too, which is their enhanced oil recovery, or EOR pilot.
Using chemical surfactants.
Right. So the big problem with shale is the decline curve. A well might drop 70% of its production in the first year.
Leaving, what, like 90% of the oil still trapped in the rock?
Exactly. It's just held there by surface tension. So EOR involves pumping these highly engineered chemical surfactants down the well.
Basically like detergent in a washing machine, right?
Exactly like that. It breaks the surface tension and washes the trapped oil out of the pores.
And they're already seeing results from this pilot.
Oh, yeah. They are taking old, mature wells that were barely doing 150 barrels a day, injecting the surfactant, and seeing an uplift of an additional 100 to 150 barrels a day.
So they're literally doubling the output of a well that's already paid for itself.
With zero new drilling capital required, it's massive financial leverage.
Wow. Okay. So what does this all mean for you, the listener? Let's get to the bottom line here. Based on all this, is this a bullish or bearish signal for someone holding or considering FNE?
For me, I take a strongly bullish stance on this.
Really? Even with the commodity volatility?
Especially because of it. What stands out to me is how brilliantly management is avoiding those classic pro-cyclical mistakes.
You mean like buying at the top of the market?
Exactly. Usually oil companies get flush with cash and they just blow it on massive buybacks at the peak, or they do crazy expensive M&A deals.
Right. And then the cycle turns, prices crash, and they're stuck with huge debt.
Exactly. But Diamondback is doing the opposite. They are hoarding cash right now.
To pay off those 2026 and 2027 debt maturities we talked about earlier.
Yep. They're building an absolute fortress balance sheet, loading up on dry powder.
So that when the cycle does inevitably turn downward, they have the liquidity to just aggressively buy back shares at a huge discount.
Precisely. It's a highly disciplined, long-term wealth creation strategy. They are engineering a company that survives the bust and absolutely dominates the next boom.
That makes a ton of sense. It really is a masterclass in capital allocation.
It really is.
Well, to wrap things up, this raises an important question for you to mull over. We saw the data center power pivot, but management briefly mentioned that AI is already helping in their offices.
Yeah, they did touch on that.
But they are aiming for AI and automation to eventually manage artificial lift and optimize production on a day-to-day basis right out in the field.
Which is the real frontier.
Right. So if algorithms can successfully flatten the baseline decline rate of these massive Permian wells, which is, the ultimate enemy of any shale producer, could the intrinsic valuation of companies like Diamondback be completely reshaped in the next 5 years?
It's a massive question. If they flatten that curve, the legacy valuation models Wall Street uses are basically obsolete.
Exactly. It's something definitely worth keeping an eye on.
Well, that is going to do it for us today. Thank you so much for joining this Talk Tickers deep dive.
Yeah, thanks for listening, everyone.
Keep digging into the data, keep learning, and we will catch you on the next one.